This is eSec Money and Insights. Let's get over to our episode. We're sure, everyone. We are on video, which is a little awkward because we have a big room and we're occupying a 3 square foot space. But how are you guys? Matt, thanks for joining us.
Thanks for having me on again.
Yeah.
Fantastic conference. Shout out to the folks at ISLA that arranged this.
Yes, of course.
I think everybody in the industry in the EMEA region is here. If there's somebody you wanted to meet, whether they be a vendor, a dealer, an agent, fintech, whatever,
They're here. They have a ton of sponsors this year. I think the number was even in the upwards of 50 or maybe over 50 sponsors.
That's right.
They've had nearly 700. I don't know the exact number, but I know it was in the high 600s in terms of registrants.
Which is a record.
And I'm sure it wouldn't surprise me if others are in the region out of convenience of having the industry here as well. So it's a very well attended event for sure.
Yeah, it's been an intense few days. We'll see how this turns out because I'm a little overstimulated right now. So it could be an interesting podcast. But
All right.
happy to be here. And last time we talked about hare and horse racing. Maybe we can get to brass tacks on this one.
Okay. So Jim, I haven't seen much of you. You've been very busy. What have you been discussing with folks?
I don't know if it's a theme. I'm interested to hear what you think, Matthew. And maybe it's just a function of the meetings we set up, but financing and being financed has been a topic with every single meeting that I did this year, which is never the case in this region. Pledge was something that came up quite often. WA or capital mitigation is top of mind here, which makes sense. Starts in the US, migrates this way. Our need because of the scale in the US that happens first. It's not the normal conversation. Another thing that was a theme throughout every meeting is nobody's having an average year. Everybody seems
Above average.
above average. Very well.
Yeah. So Matt and I did a panel yesterday with some other industry leaders. They were very reflective of just the massive growth in the market and balances, revenue, volumes, everything up.
We touched a bit on it. I always classified our strategy a bit countercyclical. I never would have thought that we'd have a great year in a massive bull market. But knock on wood, that's the direction we're heading right now because there is intense demand for securities funding, like you said. We haven't scripted this, but I have a thought about what are the themes of what's going on in the markets, what we talked about last time. Last time, if people listened to the podcast we did before Christmas, we talked about 2 things that I think are still relevant right now. I talked about how I wanted to see beneficial owners get a bit more active in their risk pricing. So moving away from this utilization as a metric, I need to get more securities on loan is getting, yes, more securities on loan, but at the right price. And we talked about this intense pressure on lenders, and we talked about on the panel yesterday as well, to get themselves closer to a 0 RWA.
Right.
But my take on that when we talked last time was, how do you do that without compromising risk? Because all of these things we're being asked to do, TRS, pledge, maybe CCPs, isn't the same as the traditional transfer of title risk. So take those concepts, fast forward to the current market environment we're in, where you have this intense pressure from hedge funds on their primes to source financing. I think we're in a watershed moment for lenders to take a more active role in how they price that risk. So you can start saying, well, the traditional metrics of X% haircuts at 25 basis points for a 3-month equity funding at a 5 or an 8% haircut, that doesn't work for me anymore because these positions are getting really concentrated. There's a lot of demand and I want to price that accordingly because it is a dynamic market.
Yeah.
I think we're in a great spot. And if you can take that to the next level and say, okay, I can also consider pledge, but I am going to adjust for that in my pricing or my haircut model.
Yeah.
So I think it's a super interesting point for us.
I think the difference amongst lenders, asset owners, to the extent that they're buying into that concept and way that you think about the risk pricing of the activity. I also think that it matters why they're entering in those transactions in the first place. And I think that because of that, their risk tolerances might vary on pricing depending upon why and whether they're doing it for funding themselves and whether they're doing it to drive utilization and cash, which is the opposite of what you were talking about, but they might be thinking that way, but that just might have a different risk tolerance than you would because they're doing it in place of something else. And the something else has a price that they're comparing to.
Yeah, absolutely. So I think the fun conversation would be with some of our peers that do have that sort of internal treasury model that they want to use these products to fund themselves. Now they're in an interesting position because their opportunity costs are changing, right? So they have now options like, I can use this capacity in a securities finance transaction with the prime, or I could fund myself. And I would guess that makes a very different dynamic. How do you use that capacity most efficiently?
Yeah, I agree with you in terms of pricing and looking at performance as different than you had in the past. But our clients who are engaged and taking advantage of either funding themselves through SFT or funding others and getting paid for it on different risk parameters, it's a more narrow scope of clients. When we have conversations with them, we're already seeing pricing differentials. So for those clients, I can price plain vanilla treasury collateral different than equity collateral, all else being equal. And that hasn't always been the case because you're asked to perform utilization matters. So I agree, we're at an inflection point here. It's starting to happen. But you could have different pricing. If we have somebody who has different opportunity costs, that makes a market having, but you can't be ignorant to pricing risk into it. And so everybody views risk differently. Matt may view it different than our top clients.
Right.
Jim, when you get demand from brokers or primes to do a funding transaction, let's say a 3-month evergreen, does your desk just price and execute that? Or do you pass that on to this group of clients that want to do these transactions? And do they have any view on the pricing in that?
They do. Usually it's the latter is the model that we do. I don't think we need to do that. We like to do that when our clients like it. Some of those trades get done and some don't, which in and of itself means they're pricing the risk.
Yeah.
Taking the
I think
risk.
that most of the types of clients we're talking about, where they're doing it for funding purposes, they're heavily involved in understanding the pricing of the trades going on and what their tolerance is for that.
Many times they're in the market other than the SBL. They're in the market with repo or other products. And so they do know the pricing and they compare it to opportunity costs that they have otherwise.
I ask because I think it's one of the new dynamics in the market is you used to be able to say, yeah, let me take that away. Let me check a few things. Let's see what else is going on. And the dealers were pretty patient. They give you a few days, maybe even a week. Maybe you need to set up a new collateral schedule, something like that, right?
Mm-hmm.
But now I think the demand is so intense that it almost feels like, and I think there is some reality to this, that hedge funds are coming to their primes and they're saying, where can you price funding for X yards in this asset class? It could be Asia, it could be US tech, it could be something else. Whereas past would have just priced that out and then gone and looked for funding, that now it's almost like they're flipping that around same day, coming to probably your desk and our agent lender desk and saying, where can you price this? And the point is, I think speed matters now.
Yeah.
That you have to, from the beneficial owner side, if that's coming through directly to you, you have to be in a position where you can make decisions pretty quickly on where you want to price that risk.
Agreed.
Yeah.
I think those beneficial owners engaged in the market this way are positioned now to do that. I mean, whether they themselves are trading it or they're directing trades and that active engagement.
Yeah. We've seen a number of clients change infrastructure to support funding needs internally. So positioning themselves to react more quickly to the market. I agree. Things move quicker now.
You know what I thought was interesting? One of the panels yesterday on capital constraint, regulatory capital and other factors and updates there, they had the different solutions. They saw the market looking towards moving to a zero risk weighting, and it was CCPs, it was consideration of credit ratings, it was pledge, and it was one other.
Asset seg, maybe.
No, it wasn't. I thought that the list was somewhat narrow in scope and limited. I didn't think that the list was all encompassing. There's a lot more creative trade structures and ways that I think dealers are.
Netting agreement.
It was netting. Thank you very much. Yes, that was the fourth. But it was lacking some of what I thought were the trade structure solutions. So to me, it was more infrastructure decisions around, are you doing pledge or is there a netting? In some jurisdictions, credit ratings matter. Others, I appreciate they don't. But anyway, I thought it was interesting that it was glossed over. It was mentioned briefly, but it wasn't the core function. How much were some of those other solutions discussed this week? And
Solutions being
Right.
not as much as
As the US.
correct.
Okay.
Yeah, a little lighter. So,
So maybe
maybe
that's why,
reflective of
that's
what you're
kind of
hearing.
what I was curious if it was here in Europe and with a lot of the European banks that they're just either not yet positioned to need it or using an alternative solution. Like pledge works the best for them perhaps. And so maybe that's why.
Yeah.
Okay.
Or it's just they're not there yet.
Mhm.
And if the infrastructure's resolved and they're still left with the need to optimize, then those trade structures will come into place.
Right. I know you've reviewed pledge in years past, Matt, and I know that I had a risk lens around the legality of the perfecting collateral and things that maybe wasn't as advantageous. Do you see the potential that the market will shift to that model regardless in the future and that you have to think about it? I know that from a risk weighting perspective, you guys aren't being probably asked to do those things because you're already at very low risk weighting to counterparts. But do you see the market eventually being forced to go along with the rest of the market at some point? Do you have a view on that?
Yeah, I mean, we've had the luxury of being able to wait to see how things play out and to get a bit smarter about how we implement it. But yeah, we'll get pulled along with the market. There's a couple aspects to that. So yes, we're a zero risk weight in most jurisdictions, but not all, right? So
Right.
there's differences. Switzerland's one that sticks out, right? So they have different rule sets that were implemented quite early, could be relevant for us, for counterparties in that region. But it's also because of our size, we start hitting other metrics, and most of those have to do with single counterparty concentrations. And so there is some relief needed in certain places. Pledge is absolutely on our list this year to do. We've done cursory work around it that I've commented on before. Now is legal and risk deep dive. But I think we end up in a place where we implement it not all in because we don't need it everywhere, but maybe at the margins, and quite similar to what I think you yourselves have done with asset segregation is if you think in the concept of, okay, we can take a little more risk on the margin or the haircut. So you can have a transfer of title as sort of your core risk management, but you can have pledge or asset segregation for the bit that's covering the volatility in those positions.
Yeah, it's kind of been our approach. I think pledge most certainly on the table for us this year to explore, as you noted, with a very narrow focus. Keep our general contracts in place and manage risk that way. Our program, but as we look at it, some certain counterparts, we may need that in place and we have to price it accordingly.
So Christian Dale at Barclays did a nice presentation for the beneficial owners on Tuesday to get this conversation going around what are these things that borrowers are asking for? What does it mean to you? And how do you implement it? And he brought up a point. He said, if we redesign the industry from scratch right now, pledge might be the standard.
Right.
Because it makes a lot of sense from an operational standpoint, right? I mean, I didn't look up the history of this and I didn't get a chance to follow up with him directly, but I would assume the transfer of title model was made when securities financing transactions originated between broker dealers, and they absolutely needed to use every piece of collateral that they got for further transactions and margining. There's very low capitalized entities, so they have to use the assets that they have, whether it be collateral or their own proprietary assets. But most of us as beneficial owners don't do that. It's just sitting in a box somewhere for the next crisis. Other than that, we have no use for it, nor do we want to use it, right?
It's a good point. It's great effort.
Yeah.
What are some other themes and highlights of Lisbon thus far?
One that came up on our panel yesterday, and like this podcast, our panel was pretty unscripted, which I think is a great way to go about it. We touched on the subject of inefficiencies, and I didn't articulate this very well, but the market has some inefficiencies. We were talking about Korea collateral at the time.
Right.
All this funding demand is huge in the US and in US tech, but it's just bananas in a few stocks in Asia. These are underdeveloped securities financing markets. The topic was around Korea, but you can also throw Taiwan in there.
Yeah.
So it's an interesting dynamic because of these inefficiencies that a few beneficial owners or capital holders that can adapt to those efficiencies and find solutions, and this is typically in the RS space, can capture huge spreads in that. So as a beneficial owner that's developed these products, you're like, this is great for me. But thinking in long-term strategy, I still think the greatest thing in the market is to open new markets, new avenues. And yeah, you can do these transactions in TRS, but it's operationally very complicated. There's an FX hedge. So I still want the market to evolve, to have that become very systematic, tri-party, just another market that I can use in my toolbox. I think it's a weird spot in the industry where there's a subset of people that are doing really well off of this, but the industry as a whole would be better off coming to a systematic solution that works for everyone. I think that's kind of a theme, but
When you're hearing demand for the same thing, and that's a very clear message coming from the brokers on the interest to put forward some of the Korean and Taiwan.
Funded through stock loan?
Yeah.
Absolutely. Yeah. But the industry needs a solution. Those two markets in particular are very tricky.
yeah. And then another thing, I'm trying to pick up things that we talked about before. We picked up a little bit yesterday is I think it's also a strategic advantage to be a good operational counterparty. So be a lender who is easy to deal with, right? Very few reconciliation items, very few fails, et cetera. Your recalls are timely, your collateralization, your marks are agreed, just be a technologically adept lender that transactions are low cost or low touch and mostly automated. What we didn't get a chance to get into is AI, and I expected everyone here to be kind of talking about that, but I guess that's the theme for today and how you apply that to your securities lending program.
I mean, I think it makes a lot of sense because we as lenders, and I'm sure other agents, think about the borrowing counterparts and how efficient they are and how operationally easy or not they are to deal with. And I know you have a lot of conversations with counterparts of greater automation, how we can put more things in place, what other platforms we need to get on or adopt in order to be more automated and straight through as best possible. Low touch. You don't want to have to touch any of it.
No, especially in tricky markets.
Yes.
I laugh because we're told often that we are difficult to deal with, but it really has to do with
That's just you. That's
well,
just you.
it is a reflection of me.
By the way, for everyone listening, we were scheduled to do this yesterday. Someone wasn't available and it wasn't me.
Sorry. It's not being heard.
He did note that I don't think he's ever been stood up by an agent lender before for a meeting. So we'll have it be known that Jim Maroney was the first to stand up Matt Brunette.
So I think operational performance is super important. One of the biggest risks in this industry is operational risk, right? You're operating, we're lending in 35 markets. We have 8,000 unique securities that are out on loan on any one time, right? And so we have to have a systematic way of managing that operational risk. And when I start thinking about AI, I was wandering around here looking at the vendor booths and I was like, so the background for this is my team does a lot of work in building our own tools, our own analytics, our own trading platforms, et cetera, to make ourselves a better counterparty. Thinking like now with AI, wow, what happens to these vendors when people can start building things themselves and automating them? But then I ended up coming full circle because if I really think about our experience, we can make ourselves a lot better, but we can't necessarily make our counterparties better. So you're kind of only as good as the weakest link. So you transact really efficiently with people that are up to date on their operations and can adapt their programs. But I think you still need some of these vendors to standardize some products so that you can meet in the marketplace on different levels, that everybody agrees the rules of engagement.
I think until this whole market and industry across all of the asset classes and transactions moves on chain, then I think everything you said is still correct. But if there's a day in the future where the broad market can move to where the transaction, once it's done, it then flows through and all of the operational support processing is seamless because there's sort of the single
atomic settlement.
Yeah.
That wasn't the word you're looking for.
No, it wasn't, but I liked it better. Atomic settlement. You have to say it with a little bit of extra effort. What else? Have you gotten around Lisbon? You've seen some sites?
This Saturday.
You are? Okay.
get around.
All
It's a
right.
beautiful city.
Yeah.
Maybe that's part of the reason attendance is.
It's a great city. The weather's been fantastic. It's been warm, but manageable. The World Cup has been happening this week. So last night, England played and won. Portugal
exciting.
played.
Okay.
They had a draw.
Yes.
Yeah, we call that
yeah,
a draw.
yeah, we call that a draw.
1 point.
It's been fun. Good atmosphere, good vibes in Lisbon as well.
Not to
So-
mention Norway 4-1.
Okay, I didn't mean to not mention Norway.
Outstanding.
Go Norway.
Go US.
Go
We won
US.
as well.
The US has only played the one game though, correct?
Yeah.
Okay.
Yep.
All right.
Play tomorrow.
Okay.
Yeah, fantastic city. It's affordable. One reason why ISLA had it here is you can get more people here because it's within budget. Beautiful city, great location, great venue, and it doesn't break the budget.
Or Lisbon.
What's next? Are you done for travel, or at least work travel, business travel for a bit?
No. I think
No,
I
no.
have a few spots on July.
Okay. Matt? What
No,
about-
no travel in July. July is recovery time for
Norway.
me and my Scandinavian neighbors. So
Yes.
that's when everybody heads to some body of water.
Uh-huh.
Hopefully read a few books, barbecue a lot, do some water skiing.
Yeah.
That's the whole plan. As little as travel as possible. And then it gets pretty intense come to the fall. We have the GPFA annual ISLA America. I have a niece who's getting married in Wyoming. I got to
Okay.
try to get there. Yeah.
Yeah.
So it's all in again after the summer.
Okay.
Get your rest, July.
I need the rest now. I could use it on my flight home. I have a little bit of catching up to do. All right. Well, Matt, thank you for joining
Thank
us.
you, Matt.
Yes. Listeners, sorry, hopefully our audio was strong enough. And for those, we're on video mainly because I've heard from people this week that there are some that just watch our podcast and listen
Yeah.
to it on YouTube. I'm not encouraging our listeners to do so. I'm going to put it that way. There's nothing.
Oh,
fancy
I'm
about
sorry.
it.
I did have one thing. Last
Oh.
time we talked about almonds. We said we would only do another podcast if we got viewer recommendation that they actually wanted more of this
Well,
exchange. I went on to both your Spotify and your YouTube side.
zero comments.
No
Uh,
But
comments.
we get a lot of in-person
Yeah, okay.
comments.
Is that what it is? The
Uh,
in-person?
I got a lot of in-person comments this week.
And I also didn't get, the thing I prepared most for was the one-off questions.
That I tend to ask.
Yeah,
Okay.
but we'll do that next time.
What did I miss? What should I ask you?
No, let's end this. Let's end
Yeah.
this.
Okay. How do we say goodbye in Portuguese?
Bye.
We're 4 days in to being in Portugal and none of us had figured that out yet. We'll work on that.
I only
Before we
come with
return-
Spanish.
Okay.
Vaya con Dios.
Thanks, listeners.
Adios.
Thanks for listening. And now for our disclaimer.
This material is for your private information and does not constitute legal, tax, or investment advice. There is no representation or warranty as to the current accuracy of, nor liability for, decisions based on such information.